Everybody, good evening. Welcome to our legislative town hall on condo insurance. So before we begin our program, I wanted to just do a shout out to and thank Principal Ron Okamura from McKinley High School for making the auditorium available for us. So thank you to Ron and his staff. I think Ron is here somewhere in the audience. I also have a few housekeeping announcements. So first, restrooms are in the back on the right, men's is on the right, women's is on the left. If you haven't signed in yet, could you please sign in at the table in this aisle? We wanted to update all of our participants going forward, so if you sign in, we can send you updates. This meeting is being videotaped, it is being recorded, just for your information. Our plan was to play it back through our Capitol House of Representatives legislative website. Okay, also at the sign-in table, we do have cards, question cards. If you think you're going to have a question and you don't want to use a microphone, then feel free to write your question on the card and leave it at the table, and our staff will bring it up to us. Okay, I'm going to start with introductions. First with our legislators. This is basically your urban legislative team. So I'm going to ask Senator Moriwaki if she could introduce herself first.
Thank you, Speaker. Aloha, everyone. Nice to see all of you here. I'm Sharon Moriwaki, I'm your senator, and glad to be here to meet with you and hopefully address some of your concerns. I'll turn it over to Representative.
Aloha, I'm State Representative Scott Nishimoto. I represent the 23rd District, which is Mo'ili, Ili, and Makari.
Aloha everyone, my name is Adrian Tam. I represent District 24, which encompasses part of Mo'ili, Ili, and all of Waikiki. And I want to thank all of you for being out here and spending your evening with us today.
Okay, I'm Scott Psyche. I'm the state representative for District 25, which includes basically all of Kaka'ako and portions of Ala Moana. I'm also the Speaker of the House of Representatives. So I'm I'll introduce the panelists as we get to their discussion topics tonight. But as you know, we're here to discuss condo insurance. And there's 4 areas that we wanted to focus on tonight. The first is, why is the cost of property insurance or condo insurance increasing? Second, what is the impact on unit owners from a financial or lending perspective? Third, how can associations and unit owners mitigate claims and the cost of insurance? And then fourth, how is the legislature trying to help alleviate the situation? So we have a panel here that's going to actually cover all of these topics for us, and we're really thankful that they're here tonight. So these panelists have a lot of experience in the insurance industry, banking and lending, and also with condo management, property management. And so between the 4 of them, there's 145 years of work of experience and expertise. So I want to thank them for being here tonight. The first presenter is Mike Onofredi, and he is representing the Hawaii Insurers Council this evening. Mike.
Good evening, everybody. Thank you very much for coming. Thank you, Speaker Saiki, Senator Moriwaki, Representatives Tam, Nishimoto, for helping put this on. So the question is, why is the price of condo insurance increasing? And there are several issues. The starting point is really the insurability issues for losses caused by things like water damage and fires, and basically all losses excluding hurricane. And then secondarily, there are banking and reinsurance issues for losses caused by hurricanes themselves. So I'll touch on all of those. There are basically 3 different coverages that are required when you live in a condominium. First is coverage to protect the building from things like water damage, fire, vandalism, everything other than hurricane. Then there's coverage to protect individual unit owners. Sometimes it's called HO6, sometimes it's just called unit owners coverage. And that will protect your own belongings, your additions and alterations if you put in custom kitchen cabinets and that sort of thing. It will also provide for loss of use if your home is damaged and you can't live there, or if it's a rental, you can get coverage to protect for your loss of rent for while your unit is unable to be occupied. There's also liability coverage that's involved, so if somebody trips and falls in your unit, that you would have some protection if you were sued for that. Again, I'll refer to this as HO6 or unit owners coverage. And then finally, there's coverage to protect the building against hurricane losses. That's purchased by the association, as is the other building coverage I referenced. So first, why is the cost of non-hurricane building coverage increasing? Well, right now in Hawaii, there are only 3 Hawaii licensed insurers offering this coverage, so the market is fairly fragile. The primary reason is water damage. Since about 2016, the number and cost of water damage claims has been rising significantly. And it's been rising every year. Each year seems to get a little bit worse than the prior years. These claims are primarily from older buildings where plumbing updates, pipe replacements, etc., weren't performed in a timely manner. So the pipes are failing within the walls. These older buildings at this point are not insurable by a lot of technical insurance definitions, certainly not at the prior pricing. Hawaii has experienced very low property insurance rates relative to the rest of the United States until the last few years. So what's happening now is that insurers, in order to make the buildings insurable, have increased pricing, they've increased deductibles in many cases, and they're trying to do that in an effort to continue to offer coverage despite the claims continuing to increase. One of the challenges is insurance is a risk-sharing mechanism, which means that people who don't have claims sometimes have to pay for those that do have claims. So that means that coverage in really all buildings in Hawaii has been getting more expensive over the last several years. Some new buildings have also had issues. Less often, in some cases, it could be construction defect because it's a new building and the first week you move in, there's water flooding down the elevator shafts. That actually happened in a new build in Kaka'aka. So that's for the building for the non-hurricane claims. So why is your unit owner's coverage getting more expensive? Also water damage. 514B is a part of the Hawaii law that deals with condominiums, and it allows 3 different ways to resolve claims. The most frequent method is that each unit owner would pay to repair their own unit. So that way it doesn't determine liability. It's not that your upstairs neighbor overflowed the toilet and it caused damage to your unit and several units below it. It's basically everybody takes care of their own damage and that's it. So that puts more emphasis on the unit owners, insurers, to provide payment for those claims. That type of settlement has been increasing fairly rapidly. The other 2 ways to settle claims are that the at-fault unit owner would pay or their insurance would pay, or that the entire building would pay in sort of a common assessment. Richard later probably knows way more about that than I do. And as we know, if you have a water loss on an upper floor, they tend to cause damage to multiple units in the same stack or sometimes even in the adjoining stack. So that's what's really happening in the HO6 world. AOAOs are now often requiring unit owners to buy increased loss assessment coverage or additions and alterations coverage. I mentioned earlier that deductibles are increasing for the building coverage that AOAOs purchase for the entire condominium building. So as a result, those higher deductibles are causing the AOAOs to ask all the unit owners to buy more coverage in the event that their unit is damaged. And that can be through loss assessment coverage or that additions and alterations coverage. That's increasing the cost for unit owners to maintain insurance in their units as well. Insurers, as a result, result, have filed significant rate increases over the last several years as the claims costs have skyrocketed. So combined with the higher coverage requirements imposed by the AOAOs, the result is an even larger increase in unit owners' coverage premiums. Again, it's a risk-sharing mechanism, so these costs are borne throughout Hawaii in the insurance market. And again, the primary cause of this are pipes inside walls that are failing. That's really the driving factor here. So then finally, why is the cost of hurricane coverage for condo buildings increasing? It's a little bit of a different story. Those 3 Hawaii licensed insurers also offer coverage for hurricane, in addition to offering coverage for all other types of losses. But 2 things are happening now. One, there are some banking issues. Fannie Mae and Freddie Mac, which are federal entities that purchase loans, is that the right way to say it? Purchase loans from lenders. And they're requiring that hurricane coverage needs to be the same amount as the coverage for all other damage to the building. I believe it's a long-standing rule they've had. But one of those 3 insurers that's licensed in Hawaii now does not offer hurricane at that same amount. They're offering a much lower coverage limit. That's causing a gap in coverage, and filling that gap is fairly expensive. On the banking issue, Victor and Linda will discuss that in a little bit more detail. The second thing that's happening is insurers buy reinsurance coverage. That's what we buy to protect our customers. So with the tragedy that happened in Lahaina, every company had some sort of reinsurance. You're buying that from things like Lloyd's of London, which is probably a company name you've heard of. And we're buying that to protect our portfolio of business, to make sure we have enough money to pay claims. And were it not for reinsurance, the result of the Lahaina fires would have been several insurance companies would have gone out of business. And typically insurers buy this coverage to protect against large catastrophic claims. Another example of that would have been the tragedy at Marco Polo. There was a lot of reinsurance that protected the building's policy, and without that, it could have been even worse than the loss was actually. Reinsurance is worldwide, and reinsurers have been losing a lot of money around the world since 2017, starting with the California wildfires, storms on the Atlantic seaboard and the Gulf Coast, European storms, and various other events. They've been raising reinsurance premiums for several years to try to return to profitability. Hawaii reinsurance premiums have actually been going up a little bit lower than in other states, but that's now changed. After Lahaina, reinsurers have paid the majority of the claims for the tragic losses in Lahaina, so the increased cost of reinsurance is now falling more fully on citizens in Hawaii and insurers in Hawaii. So because our costs are going up, and they're going to keep going up in the future, with climate change and all the other things happening around the world, it's hard to imagine that natural disasters like hurricanes and other things are going to be less frequent in the future. They're probably going to be more frequent in the future. So what AOAOs can do is work with their insurance agents to fill this hurricane gap. So let's say that a building is worth $100 million and the insurance company will only write $25 million of hurricane. Your insurance agent can put together a program to give you that additional coverage. It's not going to be inexpensive. There's some examples, I spoke with an agent today, where it could be $1,250 a year per unit. It could be $3,000 or $4,000 a year per unit. For some buildings, it could be as low as $350 a year per unit. It really depends on the unit, the amount of coverage, and some other factors. What has happened, which is something some of you may be aware of, but something that a number of people are experiencing, is if in fact the AOAO does not buy enough hurricane coverage or hurricane coverage up to the value of the building, that creates some banking problems. And it's happened, starting to happen, I guess, a little bit more frequently. And with that, I will turn it over to Linda and Victor. Sure. Introduce yourself.
So thanks, Mike. Just FYI, all of the legislators here are condo owners and condo residents. So we are experiencing the same frustration and anxiety as all other condo owners are. So thanks, Mike, for that presentation. So the next question, the topic that we wanted to cover was, how is this impacting the banking and the financial side of condos? And we have two longtime bankers with us, Linda Nakamura and Victor Brock.
Thank you, Speaker. My name is Victor Brock. I'm with Mortgage Bankers Association of Hawaii, and I'm joined by Linda Nakamura, also with Mortgage Bankers Association of Hawaii. So, thank you, Mike, for doing such a thorough job in explaining the situation with the insurance and setting the stage for the quagmire we're in with financing of units that are in these condominium buildings that have a shortfall or under insurance for hurricane insurance, potential losses. Mortgage lenders in Hawaii, locally based mortgage lenders, and mortgage lenders who are from the mainland who lend in Hawaii kind of have to play by the same set of rules. We all sell a good portion of our loans to Fannie Mae and Freddie Mac, who, as Mike mentioned, are government entities who purchase or guarantee loans that we originate. And the reason we sell loans is so we have sufficient liquidity and funding to make more loans here. Excuse me. So we are tied to the Fannie Mae and Freddie Mac rules that require that the building be 100% insured for hurricane losses as well as fire or other hazards, flooding, disasters. So if we want to sell a loan to Fannie Mae or Freddie Mac, we have to make sure that that building has 100% coverage. Otherwise, we are not able to possibly, depending on the lender, whether they have the ability to put loans into their portfolio under a different set of guidelines, they may be able to put that loan in their portfolio. If they don't have that option, because they're a standalone mortgage bank, then their hands are tied and they simply cannot originate that mortgage. So whether it's a refinance transaction or a purchase transaction, that lender may not be able to fund that mortgage application. And so this impacts you folks who have condominiums if you're trying to refinance, if you're trying to get home equity lending financing or home equity line of credit to do repairs or improvements, and also for those potential buyers, if you're trying to sell, that buyer may have a hard time finding financing to buy your unit. And unless you have a cash buyer, it might delay the sale transaction of your unit, and it can also make it unviable for them altogether, depending on whether they have more down payment, or if they need VA 100% financing, they might not find that available. So some of you might ask, well, why does Fannie Mae and Freddie Mac require 100% coverage if the building association board decides that they are happy with 25 million in coverage? So let's say a building is worth 100 million, the example that Mike gave, but they only have 25 million of hurricane insurance coverage. Why would Fannie Mae and Freddie Mac not accept that if that's what the board of directors of the association has found an acceptable amount of insurance? Well, Fannie Mae and Freddie Mac have requirements for all states. It's nationwide standards. There are a lot of hurricanes that come through Florida, and they have the same standards for condo projects in Florida as they do in Hawaii. They can't make custom guidelines for the state of Hawaii. And we have been lucky in Hawaii since 1992. There's been no major hit of a hurricane. But I would ask you all to go on YouTube and look for a video for Acapulco, Mexico, which was hit I believe it was August or September last year, with a Category 5 hurricane. And look at some of the videos and the damage that that unexpected Category 5 hurricane did to those high-rise apartment buildings, hotels, and condominiums. It was very devastating. So even though there may be a less devastating Category 1 hurricane that would come through and maybe only do $10, $15 million of damage, I say only, that's a lot, but on a $100 million building, it might not completely destroy the building, and that $25 million coverage might be sufficient, but it might not if a very severe hurricane comes through Hawaii. And we could keep our fingers crossed for decades, but it might happen, unfortunately. So we have to meet the requirements of Fannie Mae and Freddie Mac, otherwise we're not able to extend financing. Some lenders, as I mentioned, have the option of financing mortgages with lower loan-to-value or lower down payment and putting those mortgages and holding those in their portfolio. And I'm going to pass the microphone off to Linda and ask her to explain that decision-making process about keeping a loan in a portfolio and what some of the issues are for local lenders that decide to do that.
Thanks, Victor. And Linda Nakamura with the Mortgage Bankers Association. So as Victor had explained, as lenders, we will sell our mortgages on the secondary market to Fannie Mae and Freddie Mac, or we can portfolio it. But if we portfolio that loan, that means we take on that risk. Anything happens to that loan, if there's a loss, the lender takes that loss. And if we have too many losses, we have some safety and soundness issues with our regulators. We have to make sure that we have to reserve for losses. So if your condo, if we lend in every single condo here where there's insufficient insurance, hurricane insurance, we're going to have to reserve much, much more for these losses. And if we have to reserve much more for these losses, then the cost of lending may also go up for everybody. And again, to reiterate what Victor said, what does this mean to you as a unit owner? It means you may not be able to find financing. If you're trying to sell your unit, you have to find a cash buyer because your buyer will not be able to finance. You may not be able to get a home equity loan to do, redo your unit. So again, there's a lot of financial ramifications on not having that sufficient insurance. So what can you do as unit owners? You can go to your AOAO. You should find out, do you have sufficient insurance? I've actually spoken to many people who did not even know that their condo project did not have sufficient insurance. And some of them that I've spoken to were actually able to go back to their AOAO, find out if they had insufficient, and they were able to go get sufficient insurance. So, again, you need to go and, talk to your AOAO, find out information, because, again, this affects all of you, or unit owners.
Okay, before we, thanks Linda and Victor, before we go to our next presenter, can I just jump in and ask you to explain something that I think is happening here? Because I've heard anecdotally from residents at 3 buildings in the Kakako area that their buildings are on a do not lend list. Can you explain what that is and what the ramifications are and how extensive is that list?
Each lender does their own due diligence with respect to condos. So if you go to Bank A, it might be different from Bank B. So what happens is an individual wants to, say, purchase a unit at X condo. They will put in an application for that condo. Their mortgage loan officer will go and check to see if that condo has enough insurance. So if that condo does not have insurance, that loan officer will know, we can't sell this to Fannie Freddie, and we can't portfolio it. So they will let the buyer know that you can't finance it. So there's about, I believe, there's about 400
projects out there that do not have sufficient insurance, is my understanding. And again, every lender does their own due diligence. So, you know, whichever lender you decide to, you know, go get financing for, I mean, that's going to be the process. They'll be able to find out for you upfront, or they may need to do some research.
Let me just add to that. So there is no one do not lend list. So as Linda mentioned, one bank may have a list that they maintain or not of projects that they've identified already that have a shortfall in the hurricane insurance coverage. But you go to another lender, they might not be aware. So it might not be until after your potential buyer, or if you want to refinance a unit, you go to a particular lender and then you say, here's my condo project, they do some research, and then they find out, oh, this particular condo does not have 100% hurricane insurance coverage. After the fact, after you're 5 days, 10 days into the process, you may discover that it's not sufficient insurance. The loan officer doesn't know that in advance. And some lenders have the option of other funding sources where they don't necessarily have to follow Fannie Mae and Freddie Mac's guidelines. So it might be an option of shopping around from one lender to another, and you might, but your buyer, if you're trying to sell, like I gave the example of VA Veterans Administration loan, 0 down, 100% financing. Some buyers need that. They don't have the down payment, and they need to find a unit, a property that will be acceptable for VA financing. And so if they are trying to buy a unit in a project that does not have sufficient hurricane insurance coverage, that lender might say, well, I cannot give you VA financing. I can't give you no down financing, but I can give you a portfolio loan, or I have a source on the mainland that will buy or will fund 80% of the purchase price. So even if financing is available, it may be more limited options for your buyers, or if you want to refinance. You may have more limited options, and or your interest rate may be higher.
Thanks, Linda and Victor. So again, for the audience members, if you have a question that you want to write down on the cards are available at the desk here in the aisle. So please submit your cards. So, you know, the purpose of this, one of the purposes of this meeting was to provide information to residents. We didn't want everyone to feel depressed when you leave tonight. So the next portion of the panel discussion is going to focus on what steps we can take to be proactive to try to mitigate what is happening. So with that, I'd like to introduce Richard Emery, who is a longtime property management executive in Hawaii.
Aloha. Aloha, everybody. Can you hit this on? Is it working now? Testing. Okay. Well, aloha. My name is Richard Emery. I'm a longtime condo industry person. I'll come back to that in a second. But every time the speaker talks about this panel having 140 years, it makes me feel old. Then I start to think back about my experiences when I crossed the Delaware with George Washington. And I'm willing to share that with you in a break if it comes up. But the reality of it is, I've been in the condo business for over 35 years. A little bit of background, I owned my own condo management company. It was the third largest in Hawaii. I participated in our Industry Community Associations Institute. I was one of the first people in the United States to get the Reserve Specialist designation. So I've done reserve studies since the 1995 requirement began for our effective year of 2000. I was on the National Task Force for Reserve Study Public Policy. And I'm a parliamentarian, and I'm very engaged in lots of activities in our industry. What I want to talk about is more organic. Because you as owners or board members are challenged with the economic situation we're in today. We're not just insurance costs, but all costs are going through the roof. We've seen explosive inflation. We've seen our employees wanting more money. We have insurance going up. And unfortunately, some boards have fallen into the habit of saying, we'll make up the deficit and not raise maintenance fees by cutting reserve contributions, which is a very serious detrimental problem. Let me give you just a couple of statistics. First of all, there's about 2,400 condominiums in the state of Hawaii. They said we have to be 50% funded because they were worried about the economic cost to owners of complying with fully funded reserve studies. But what does 50% funded mean to you? Does that mean you have 100% of the money you need when the repair comes due? Are you saving for half the money when the repair comes due? In simple terms, that's what you're doing, although I would tell you, if you got very technical with me, if you're 40% funded, you're more funded than a cash flow 100% funded. It's a statistical thing that I'm not going to get into today. But the reality of it is, for some reason, I do this lecture around town. I find boards take the position that their goal in life is not to raise maintenance fees. Their goal is they can't raise maintenance fees, and what are they going to do? They're going to find a way to make the budget maybe not realistic, or maybe they're going to say we'll put less money in reserve. And because I do a lot of expert witness work on lawsuits, maybe they'll say, well, let's just pretend the common element air conditioning system doesn't exist. So when you take the air conditioning system out of the reserves, then in fact our reserve study looks better. You know, so we've seen a real pressure over time that boards haven't done this. And let me just quote 514B-143 on insurance. And it talks about providing building insurance. And it says, the total amount of the insurance shall not be less than the fully insured replacement cost. So do you have as a board the option to insure for less than replacement cost under the current statute? Well, let me tell you one of the other rising costs we're not going to talk about today is director and officer liability insurance. We have the highest rate of lawsuits by owners against boards and vice versa in the country. I can tell you stories where insurance went from $1,000 a year to $30,000 a year because of all the claims on the director officer liability insurance. But if in fact you now have a policy which I looked at the other day, they required $160 million insurance, but they only insured $10 million for hurricane, what's going to happen if the claim is $20 million? Well, first question is, can you get a mortgage if you had that kind of a separation under replacement cost value? It'd be difficult. And what does it cost to get that? But the truth is, that's the environment we're living in today, is that inflation has gone crazy, and it's affecting all of us as condo owners. So what I tell people is, it's not as bad as you think. I hate to say that because it's bad. But it's not as bad as you think, because if you develop a long-term financial plan with some teeth to it, with a reserve study that makes sense, and you look at the ways that exist within the current reserve study public policy, how you can fund reserves to catch up over time, and you approach this as a business decision that you need to take care of your building, so ignoring the pipes that are falling apart is not a good decision. When I was talking to the panel before this began, we were talking about a reserve study. What you do is you take a component, wastewater pipes, all right? What's the useful life? Well, we have manuals that are probably 6 inches thick that define every component in a building. And if you look at the old manuals 10 years ago, they said the replacement cost of wastewater pipes was between 50 and 100 years. Well, 10 years ago, if I did the reserve study, I could pick 100 years, would put half the demand in the reserve study for that replacement component. Or I could pick 50 years, which puts twice the component. And so boards and reserve experts were forced to make decisions on that replacement cost. As it turned out, because the older buildings have an old wastewater system that actually the design and the material used is less structurally safe, we're finding in Hawaii they're only lasting 50 years. So in some cases less than 50 years. So the reality of it is boards need to put more time in looking at a reserve study. They need to look at putting a realistic plan together that not only covers their operating costs, because all associations do what we call zero-sum budgeting. You look at the operating costs, look at the reserve contributions, you add that up, you multiply it for the percentage of common interest. So if you're wrong on the operating costs and you're wrong on the reserve study, why would you not experience these problems? I'm an expert in a case right now, believe it or not, that the board took great pride that they hadn't raised their maintenance fees in 13 years. Now, does that make sense to anybody here? There's inflation every year. They've been in 13 years. You know how they cover the costs? They reduced this huge project from its reserve contributions to a total for 700 units to $5,000 a year. Now, does that make sense to anybody? You know, but they have this, some boards have this view that their goal is not to raise maintenance fee, when under the statute their goal is to preserve and protect the asset for all the owner's protection, because what's going to happen when all of a sudden you have the assessment? I can't tell you how many lawsuits I'm engaged in where new buyers bought in and now there's a special assessment and they're suing the board, driving up the direct and offshore liability costs, because we as boards and management companies and everyone has not done an adequate job of looking at realistically the situation we're in and putting together a plan using all the modern capabilities to work your way back in and phase yourself back into it. But you have to admit and address we're in a tough environment right now. Inflation's gone through the roof. Our reserve studies are likely, I've always guessed it's about 75% of the condos have reserve studies that are improperly funded. That's my guess from having done hundreds of these reviews. So we just have to start realistically looking at this, because you're not going to be able to get mortgages if your property's not maintained. You're not going to be able to have peace in your home if the building is falling apart. So we need to have a new attitude on the part of boards and the owners. So we need to start working together, looking at the modern capabilities that exist in reserve study public policy. Where you have deficient reserves, you can work your way back into it and get yourself back on the right path. And part of that's got to be, you have to have adequate insurance, and you have to have the strength to tackle the deferred maintenance you have and put it into a plan to deal with it appropriately. So I could talk more about this, but I see people drawing guns and bows and arrows out there and angry with what I'm saying, and when I'm going to cross the Delaware again. But anyway, so I would just encourage you as a property manager or a board, you have to address deferred maintenance. You have to put together a realistic plan. You have to look how you're going to fund that plan, including the proper level of insurance, because it's going to be critical to the long-term life and the value of your property. So thank you.
Okay, thank you, Richard. I think Paul will also recap this topic, which is how can associations and unit owners mitigate claims and the cost of insurance.
So in your packet, you're going to have a two-sided piece of paper. The first side is going to say questions for unit owners to ask their board, and the other side is things unit owners and their tenants can do to help prevent or reduce claims. Suggest you kind of look through it. You know, I've heard from some people I know that they didn't even know that they didn't have enough insurance on their building until they tried to sell a unit. So the communication between the board and the unit owners is imperative as these issues happen. So you know, there are 16 questions to ask the board. These are not exhaustive. These are just a recommendation. We think hopefully it'll help you have dialogue with your board. And if there's some hard questions you've got to ask about, when is the plumbing system getting replaced? Has there money set aside for it? Is there a policy in the building? And then things you can do in your own unit, you know, check around your ice makers, check around your toilets, under your sinks, look for leaks. All those things are telltale signs you could have problems. So again, encourage you to kind of look through that and then to interface with your AOAO board.
Okay, thanks, Paul and Richard. So I'm going to just share this story with everyone because, you know, I'm not like a handy person, but we have in our unit a water filter. And I didn't realize it, but after a while you have to change the water filter because if you don't, it starts to overflow. And I learned about this because it began to overflow one day, and so I didn't know what to do, and I shut everything off. But can you imagine if, you know, it had started to overflow if we were away for like a week or something? It would have been caused a flood. So thanks for this this handout. It's a really important handout. So Paul is going to discuss our final topic. I mean, Mike. Sorry, he's saying Paul. Mike is going to cover our last topic, which is what is the legislature working on now to mitigate the situation?
So, the speaker mentioned a water filter system. I'll tell you a story about my house. 20 years ago, we had a water filter system under the sink, and the canister cracked. 9 hours later, when we came home, we had soffits falling down and everything else. So water is tough. It goes where it wants to go. It flows all the way down and it causes all sorts of damage. So, do as much work as you can to check your unit to make sure that you're keeping it as safe as you can. So, what is the legislature doing to try and address the issue? The greatest concern right now, given the limited number of participants of insurance companies willing to write condos, is what happens if one of those three decides to exit the market, or they decide to reduce the amount of business they're writing. Well, if they do, there'd probably be coverage available through something called the surplus lines market. These are companies that are not licensed to write business in Hawaii. They're licensed elsewhere, but their rates are not regulated. The terms and conditions of their policies are not regulated. So they tend to be very, very expensive. So what the legislature is doing to try and address this potential availability of insurance problem is we're considering two bills, House Bill 2686 and Senate Bill 3234. What these will do is expand coverage written by two programs. These are called markets of last resort. One is called the Hawaii Property Insurance Association, and that will cover everything other than hurricane. So the bill would expand HPIA so that it could cover condo buildings. It was designed originally to cover homes on the Big Island that were near the volcano and were subject to lava inundation. But the legislature is considering a measure that would expand it to allow it to cover condo buildings. The second is to restart and expand coverage from the Hawaii Hurricane Relief Fund. HHRF was enacted after Hurricane Iniki because, not unlike what's happening now, reinsurance became very expensive. A difference was it also became very unavailable in many cases. So the HHRF came in and allowed homeowners to have hurricane coverage on their property, to allow them to get mortgages and do all the other things we need to do. The bills are sort of unique. They include funding from insurance premium assessments, but also for mortgage recordation fees, conveyance taxes, and other sources. And it recognizes these are not insurance issues, these are societal issues right now. And please understand that premiums under these programs are not going to be cheap, they're going to be expensive. The legislature has the ability to address availability, but not really affordability. My expectation is that HPIA or HHRF policies will be less expensive than those policies from non-licensed insurers, the surplus lines insurers, but much more expensive than premiums charged by the Hawaii licensed insurers. And as I said earlier, Hawaii property insurance, and I know it's hard to say that because you're paying the premiums now, you're seeing the increases, and it's really difficult. I understand that. Hawaii property premiums have been lower than the national average consistently. For example, in 2021, which is the last year that this data is available from the National Association of Insurance Commissioners, the average unit owner's premium in Hawaii was $383. The national average was $531. And if you look at places like Florida and others, it was substantially higher than that. But in Hawaii now, the premiums are catching up. The rate of rate increases is going up pretty significantly for unit owners coverage. Plumbing updates are needed at the same time. Many of you may be in a building that is trying to determine how to install sprinklers because there's a mandate from the city and county of Honolulu to either install sprinklers or have some other fire remediation plan. So there's a couple of other bills pending in the legislature that can help that. One is House Bill 2801. It's got a companion bill in the Senate, Senate Bill 2727. And this is an innovative program that offers lower interest rates and longer amortization periods for loans that could apply to condos. So if you need to replace the pipes in your walls at the same time as maybe you need to install sprinklers. I mean, let's face it, if you're going to have to repair your pipes and you have to put in sprinklers, it's probably a lot more economically efficient to do those things at the same time. so you don't have to rip out the walls twice. But this bill, it's called the C-PACER loan program, at least gives unit owners the ability to spread the cost over a longer period of time at a lower interest rate. And then finally, what can you do to help yourselves? Richard touched on some of this. AOAO boards have to fund plumbing system replacements and regularly inspect and update other critical building systems. That includes chillers and air conditioning systems. We've seen claims from chillers leaking, and again, if they're on the roof, they leak and they go through multiple units all the way down a stack. Ask your AOAO board important questions about the health of your building. Those are on that sheet we discussed earlier. I can't emphasize enough that talk to your board, get on your board, join your board so you know what's out there. Ensure that there's regular dialogue between the board and you as a unit owner. And then finally, check your own unit to make sure that if something happens, you're not the source of the leak or the damage.
Okay, thank you.
All right, thank you, Mike. Those were the 4 topics that we wanted to cover, and we thought we'd go into a Q&A right now. We do have a few cards that were submitted, so Senator Moriwaki, do you want to start?
This is a question about the board was informed that the insurance has increased 10 times from $59,000 to $690,000. Isn't this controlled by the state, or what is being done? I think you mentioned some, Mike, but those who can't afford the $500 more per month for the upkeep.
Yeah, so as I mentioned, if your building is insured by a Hawaii licensed insurer, the Hawaii Insurance Division has authority to review and approve the rates that are charged. If, let's say, and this is a guess, that at the time the building was paying $59,000 in premium, it was probably with a Hawaii licensed insurer. I would further guess that that insurer probably canceled the coverage or non-renewed the coverage on that building, and then the only coverage available that the agent could find was through one of these non-licensed surplus lines insurance companies. So at that point, the price for that policy is not regulated by the Hawaii Insurance Commission. So I wish there was a better answer, but that's what's happening right now.
Okay, next question. How many buildings with fire sprinklers are ever tested if their sprinklers work? Doesn't having sprinklers give a false sense of protection?
Richard, question for you. Well, normally most associations have a contract for the maintenance of the fire sprinkler system and regular testing by an approved company. So I don't think that's a concern that the fire sprinklers aren't going to work. They're regularly tested by licensed professionals as part of the normal maintenance and contracts of the association.
Okay, so this question is, says, who determines or calculates building replacement costs? Are the calculation methods consistent across the state?
Yeah, I'll give it a shot. I think there's, and I'm not an insurance agent. I'm sort of in the back end of the insurance business. There are entities that can go value buildings. Hawaii Insurance Bureau has reference of what they believe the value would be. There's going to be tax assessment records. I'm not aware of the, so Richard, in your experience, the evaluation of the building?
Well, the industry, we basically tell the boards to have the underwriter determine the value, because the last thing you want to do is determining your value and finding out it's insufficient. And so we try to push it back to the insurance company to provide the value. I'm not sure this applies universally to all policies, but one of the risks you have with insurance is something called co-insurance. So let's assume your building is $100 million replacement cost, and you choose to buy $50 million in coverage. And now you have a $50 million claim. How much money do you think you get? And the answer is $25 million, because you're considered a co-insurer. You're only insuring for half the cost, so you're only going to have the value of your claim of half the cost. Now, there are endorsements you can buy to make that non-applicable, but the reality of it is we tell boards that they should ask the underwriter to determine the value, and that way they're protected.
Right. And that tool I mentioned from Hawaii Insurance Bureau is something that insurance underwriters will use. And co-insurance is one of many terms and conditions that the AOAO board really needs to discuss with their agent, as Richard said, to understand what happens when there's a claim, to understand how much money will be paid in the event of a significant loss.
I have a question for Linda and Victor. What are some of the criteria or factors for a bank to portfolio a loan with less than 100% coverage?
Okay, I will take that and I'll hand it to Linda, who works at a different organization. We're looking at our exposure. How many units do we already have loans on in that particular building? So if we have 0 loans already outstanding on a building, and the gap between the 100% value that should be insured and their actual insurance, we're also going to look at that. So we have seen examples where a $350 million building to rebuild the whole thing only has $25 million in insurance coverage for hurricane loss. That's a big gap. That's a gap of $325 million. But we've also seen another building where it was only, I believe, $80 million to rebuild the entire building, and they had $25 million in coverage. So it's a smaller gap. So we're looking at how many units do we already have, if any, in that building, and how big is that gap. And then we may also look at the profile of the borrower, how much down payment, if they're bringing 50% down payment, etc.
To add to that, there are lenders out there that have a 0 tolerance if there is insufficient insurance. So you're not going to be able to go to certain lenders at all, because they're not willing to take that risk. So, each lender has a different risk appetite, and, some are more conservative, some are less conservative. So again, it depends on the lender.
Yeah, these questions are all about insurance. So, what about earthquake insurance? The next one is, does underinsurance impact one's existing loan? And the last one is, I'll just read it for you. For full replacement, cost of a building varies significantly depending on the age of the building. Older condos might be valued at $100 million, newer ones around $300 million. But theoretically, to rebuild these current cost values should be similar. Insurance premiums are a lot higher for new condos as a result, which seems unfair. I think the big question is just, does the underinsurance impact one's existing loan and
Lenders answer that question.
So if you currently have a loan with a lender and your association decides to go from 100% to a less amount sublimit, your mortgage document that you signed does state that you are required to ensure that you have coverage. Currently, there is no, product out there to force place. So your lender would normally, what we do is force place the insurance. So for example, if you have a car loan, you do not have insurance, the bank will go and get insurance for you. And force place insurance is normally 4 to 5 times more than market. But for the condos right now, unfortunately, there is no product out there. We've been asking around. I do know some of the force place lenders out there they're looking for something. So there's nothing out there in the market right now. So I guess we have a reprieve in that respect until such time that there is that product.
Sure, I will just say that, so if you already own a unit and you're not planning to refinance and you don't want to sell, and you don't want to get home equity financing, you're probably okay. Just hope that no 5-category hurricane shows up and hits your building.
I think this has to do with, your condo and the board and the association and your property manager. So I'm going to read all 3 questions, and maybe, Richard, you can answer it briefly. Can condo board members be required to take a condo management course and be certified to be a condo board member? Should there be minimum qualifications, for example, property management, finances of condo, etc.? And why aren't managing companies putting a stronghold on boards anymore and guide the boards to be better? And finally, you said we should talk to our AOAO. Well, we don't have direct contact with the board. We have to go through the GM and the property management. So they will take it to the AOAO, maybe. Why do resident owners not be able to go to the board directly? So briefly, an answer.
Well, that's a broad list of questions. Let's begin with what a managing agent is, which is defined in the statute, which is, not all condos have a professional management company, a managing agent. It's defined in the declaration whether it's obligated or not. There's a lot of self-managed condominiums out there that don't hire a management company. They may have their own accountant and people in the office to do the work. So it's not one size fits all. But when you have a managing agent, the key word is agent. Under they all have to be real estate brokers under the law. So they are licensed. The company itself is licensed with a real estate broker. But they are an agent, and under the agency rule, they have to take instructions from the board, the principal, who has the decision or the right to make the ultimate decision. So managing agents can make recommendations, and so long as the decision is going to be lawful, the board can do what they want. And the managing agent has to support that under the rule of agency. Now, if they want them to do something illegal, they can refuse to do it, and then take the risk of what that they will do with their contract. But that's the rule of agency. So boards, because the principle of Hawaii condominiums, and actually condominiums across the United States, is self-governance. If you look at the Supreme Court ruled long ago that the declaration of the bylaws, these are contracts between the owner and the association. And the legislature in some ways has little ability to impair that contract or take away certain constitutional rights like a trial by a jury. So in this respect, the industry, real estate commission is charged with education. Let me assure you, there's a broad range of education, YouTube's, videos, frequently asked questions available. And then you start looking at the 2-unit condo, are you going to mandate education for a 2-unit condo? So it's kind of an encompassing question, but certainly the industry, and we have a task force, and the Real Estate Commission is currently evaluating more methods of education. I think it's imperative that boards have more levels of education and more levels of free resource to them when this comes up, that they can go to and get independent answers on how to address issues. Realizing it's never a simple issue, because we can see by the topic with insurance how many things pop up with regard to what you can do there. But I'm in favor of education. I'm in favor of mandatory education for certain size condominiums. I don't think you can take in that 1,200 condos in less than 50 units and impose the same standards on them as you do on the 700-unit condo, for example. And frankly, I see these direct and officer liability claims because we've passed so many laws making it so burdensome that every time there's an infraction, the attorney is suing the association. So we've got to balance this all out, but hopefully panels like this and future seminars and future information will give you the kind of information you need to ask. I can tell you now that CAI, Community Associations Institute, and the Hawaii Council of Community Association both Oahu organizations and one of Maui, the Condominium Council of Maui. They encourage people to ask for help and advice, and will provide them a certain level of consultation without reaching over the requirements of practicing law.
Okay, next question. If I am on my AOAO board of directors, does my individual unit owner insurance provide me insurance protection for my director activities? Mike.
So the short answer is no, it does not. But every building will buy a directors and officers insurance policy that will cover board members while fulfilling their duties on the board.
Believe me, those rates are going through the roof. I have a project that I think was $2,000 a month, and an owner made a claim on whether the board had the authority to fix a deck, whether it was a roof or not a roof, and whether they could use reserve funds. Recognizing there was no special assessment, they had all the money to fix the deck, but this owner, who was the first floor owner, said that they were using reserve funds for something I don't get benefit from, even though that deck's below them as a roof. Anyway, it went through litigation was filed by the owner. The association got a summary judgment saying that the board had the authority to fix these decks because they're roofs. And meanwhile, their insurance went to $30,000 a year.
Okay, thank you, Richard. The next question is, well, actually, there's two-part question. What happens when unit owners cannot pay the extra $1,000 to $3,000 for the hurricane cap? Because many residents cannot afford that amount. And then second, why is 100% of the building value required when most condos are made of concrete? So Mike and Linda.
Yeah, I'll answer the first part. I don't know how individual buildings work. If the coverage for the building, including the hurricane coverage, is assessed, I wish I had an easy answer to try and say, what does the AOA do? What do the bylaws say if somebody doesn't pay the maintenance fee? Because these premiums are loaded in the maintenance fee or part of the assessment, I understand. So I wish I had a good answer for that, but I'm sure there's actions that the AOAO board unfortunately would have to initiate against somebody who doesn't pay their maintenance fees.
Okay, so I have two very short questions that I think should have short answers. So the first question is it true there's only one company that installs the sprinklers in Hawaii on Oahu? And the second question is, are developers liable for substandard plumbing materials?
So the substandard plumbing materials one. So in Hawaii and in many places, there's a length of time that an AOAO has to take action against a builder. Hawaii, I believe it's 10 years, it's called the statute of repose. So for a new building, when it's first been constructed, the builder has an obligation to make it right, to try and make sure that's okay. Now, if now you're dealing with a building that's 40, 50 years old, that standard told a long time ago, and you can't really go after the building. But when a building is first constructed, ideally you would work with that construction company and they would make those repairs. I didn't catch the first part, I'm sorry.
First one is it true that there's...
I would only add that there's more than one company that installs sprinklers, new sprinklers in Hawaii. There's multiple companies that offer that service.
Mike. Hello? Mike,
Actually,
this might be
Senator, we have the second part of the question was really for the lender folks.
Let me reread the question. It says, when is 100%, or why is 100% of the building value required when most condos are concrete? That's a good question. Sometimes I ask myself that also.
But keep in mind that there's got to be one standard, or the Fannie Mae and Freddie Mac, they have a standard. Just like I said, they can't have a different standard for Florida versus Hawaii. They can't have a different standard for knowing whether a building is concrete or whether it is made out of wood. And so suggestions have been made to Fannie Mae and Freddie Mac by us to say, well, is there another way to calculate an acceptable amount of hurricane insurance less than 100% to rebuild the whole building from ground up based on some professional assessment of potential hurricane damage? And the answer was, we're not interested in listening to that suggestion, in so many words. Again, I would refer you to some of the YouTube videos of the damage of Acapulco, Mexico, because it was shocking how badly damaged a building that's made out of concrete could be damaged. And it's just like when you see a vehicle that's in a car accident, and then they tell you it's quote-unquote totaled, and you look at it and it's just like, it doesn't look that bad. Why is it totaled? Well, some of those buildings were totaled. It would not be worth attempting to repair them. It would be rebuilding them from scratch.
So can you just answer this question on top of that?
Let me just add one thing to that very quickly. So if you have a high-rise concrete building and you have the hurricane and the huge amounts of water and there's other issues, cracks in the building or whatever, so the whole foundation to the building becomes shot. What happens? You know, you have a total disaster. We saw not from a hurricane, but the problem with the Champlain Tower South in Florida, which is another story. But that's just the way it is, you know, that they require full replacement costs, and the state law requires full replacement costs. And unless the insurance industry itself changes its rules, we're kind of stuck with it.
So Victor, just an added question to that. The AO summary of insurance lists a building replacement cost of $19 million. How do I find out the real market price of replacing the building? Is there any way that... Oh,
Mike, maybe you can answer that, because I wouldn't know.
So, you know, it's a great question. Is, you know, it leads to another bigger question: is what is the, you know, useful life of a building and everything else? It's a difficult question to answer. There was another question earlier talking about if a new building costs $300 million, why doesn't it cost an old building $300 million to replace it when it's still valued at $100 million? There obviously are a lot of different factors that go into every single building. So whether that building is actually at $19 million or not really just depends on the insurance company's evaluation. Now, if the insurance company says it's $19 million, and God forbid there is some horrible event and the building's destroyed, that insurance company has to stand behind that estimate. If they said it's 19 and the AOAO said it's 25, the insurance company is basically telling you that they believe their number is correct to replace the building.
Okay, we've kind of got a Hurricane Iniki question. Since we're on the topic of Kauai, I did want to point out that our House of Representatives housing chair from Kauai, Luke Evslin, is here. He's back there. Luke, why don't you stand up to be recognized? Chair Evslin from Kauai. Also, our state senator, my state senator, Les Ihara, is here. Les, why don't you stand up to be recognized? And I point these folks out because if you have tough questions after this, be sure to ask these two people the questions. I'm only joking. Okay, so this question is, it appears that there are similar issues occurring when Hurricane Iniki happened. What actions were taken, and can these actions be repeated to resolve this issue?
That's a great question. I was here after Hurricane Iniki. Same exact thing happened. One big difference is one insurance company went out of business. The original Hawaiian Insurance and Guarantee failed after Hurricane Iniki, and it put thousands of homeowners basically looking for coverage at a time when they couldn't find any. The legislature then, working with the industry and the insurance commissioner at the time, developed the Hawaii Hurricane Relief Fund. And that basically provided hurricane coverage, allowing people to buy homes, sell homes, transact home equity loans and everything else. That happened after Hurricane Iniki. One of the reasons we're looking to restart Hawaii Hurricane Relief Fund is the same thing. Coverage is drying up, we're looking for alternative sources. In addition, now we need to get alternative sources for the non-hurricane coverage, which is why this legislation proposes to expand Hawaii Property Insurance Association.
Is there something that can be done to prevent an insurance company from canceling or not renewing policies to condos, especially if there are no major claims? And how can insurance agencies just drop people from coverage?
It's a great question. So as I said during my chat earlier, insurance is a risk-sharing mechanism, okay? Everybody pays in, but not everybody has claims under the program. So if there are excessive claims, premiums go up. The individual entity or person or building that has the claims could not bear the increased cost of insurance by themselves. So that cost is spread across the entire market. That's kind of the way it works. Now, the second part is how can an insurance company non-renew or cancel somebody? Well, if the losses are excessive and they cannot charge enough premium, that insurance company will feel like they have no choice but to non-renew coverage. If it's, I would assume that it's relatively rare if there had never been a loss in a building that an insurance company would non-renew or cancel. Most often what's happening now is these buildings have had hundreds of thousands and millions of dollars of claims, and that's what's causing the situation to occur.
Okay, we have a couple of audience members who have verbal questions, so we'll run a mic. If you could raise your hand, we'll run the mic to you. And in the meantime, while we're doing that, just an announcement. We printed 150 packets tonight, and we ran out of packets. So if you want a packet, can you please sign up at the desk, and we'll either mail it to you or email it to you. Thanks.
Bills, numbers. Would you tell us again the bill numbers that involve the Hurricane Relief Fund if we want to follow up with that?
Yes, House Bill 2686, Senate Bill 3234.
Thank you.
Just for clarification, the legislature is now in session, and we're scheduled to adjourn in early May. So these bills are making their way through the process. What's going to be really, really important is as these bills are being heard by the committees in the House and the Senate, it's going to be important for members of the public to submit testimony on these bills, hopefully in support of these bills. The committee members, the legislators are going to have to hear from the public. So it's really easy to do that. You can just go online to the legislative website, and you can submit online testimony. You don't have to show up, you can just submit written testimony. And I think what we'll do is, since whoever signed in, we can email blast updates on when these bills are being heard and the instructions for how to submit testimony. Thanks.
Hi, thanks for taking my question. Thanks for putting this on, it's really informative for us. I've served on boards for, God only knows how long, I know Richard for quite a while. You know, you have 2,400 community associations, I hear from Richard. I'm wondering why we don't have a simple system of benchmarking costs. I mean, you should have adequate access to reserve studies from all the buildings in the state. And if you do a nice study and parse out the data correctly with building size classifications, things like that, I'm sure you could come up with a quick look at the adequacy of reserves. My rule of thumb, and I used to be an investment banker, I moved to infrastructure, this kind of stuff is second nature. I've been doing it for 40 years. But if you get a minimum reserve standard, together, that would help. So these buildings that say, oh, you know, I'm really proud because I haven't raised rates in 50 million years, you would probably address that pretty adequately. So I'm wondering if you do have those kind of statistical tools available and what the current legislation does in that regard, because nobody's really addressing the basket case community associations that really mean well.
Well, I think you're correct in this sense. Currently, condominiums in Hawaii have to submit biannually a registration, which provides some superficial data on maintenance fees and reserves. And I've been saying to the real estate commission here in Hawaii that under the statute, they have the ability to gather more information. And they should take that authority they have that exists and go out and start getting more detailed information, not just about reserve studies and budgets and maintenance fees and whether there's a loan or not, and other governance type issues they may have. We don't take an opportunity to, because under the current statute, condos have to answer these questions, and they can have not necessarily every year the questions, but I think the Real Estate Commission should delve in and get more hardcore facts and data on what's going on, recognizing, you know, not all condos are not the same. Some are big, some are small, some are townhouses, some are high-rises, some are mixed use, some are senior living, some are, you know, agricultural. It goes on and on and on. So, but I think that this is a point in time in our state we need to start working on getting more detailed data about what's really going on in the industry, and have that data get segregated so you know you're looking at a high-rise or a townhouse or whatever it may be. And I think that information is generally available to start the process, but it's not available today, and the data I get is done through my own hardcore work of doing my analysis as best I can. But I think you're correct. We need to have a time in our state where we get more information.
Insurance from the ground up, and I've never understood why the valuation of the land is part of the 100% requirement for insurance. You say it's not? Okay, thank you.
Hi, thank you for putting this on. Really appreciate it. I'm part of a condo board of Aloha Towers, and we do a really good job of making sure that we have a healthy reserve, trying to do all of the maintenance, raising rates as we need to. This year we had a 8.7% increase. Last year I think it was a 10% increase. So we are doing the things that you've asked us to do, but we're an older building that doesn't have sprinklers. And so we've done all of the things that we can to basically get by without putting in sprinklers, because it would cost millions of dollars, right? But now this has meant that our insurance company has dropped us, so we had to go out on the open market. So our annual premium went from $70,000 to over $500,000, which is similar to what the first question asked, right? My concern is that, so we've been increasing rates, right? Our AOA fees have increased, but at this rate, we are going to have maintenance fees that are much more than mortgages, right? And I think that that's what many people are concerned about, that we're gonna have people who can't afford not only like their mortgage, but their maintenance fee if their mortgage is already paid off. And we're gonna have people who just can't afford more housing. So we have, like, you know, all kinds of other issues with affordable housing in the state, but we're now getting to where maintenance fees are more than mortgages. And so this is where I think we need some assistance from The lead, I appreciate the bills that are coming up, and we'll do everything that we can to support them, but we also need some additional assistance. We can't have runaway insurance costs like this. And so where are not only the state, but the feds coming in to help us out?
So there's a related question that was asked, is how can legislators help homeowners minimize costs, push back on insurance carriers regarding costs? And I'm happy to answer on behalf of the legislature. I mean, clearly this is an issue. I've said this to legislators, I've said this to anyone who will listen. We live on an island, we want to build affordable housing, it has to be vertically. You can't build just sprawl, we don't have enough space to do that. So that means we have to take care of the buildings we've got and improve construction standards perhaps in the new buildings that are going up. Right now the insurance industry is just concerned that it can't figure out how to make money on writing condo buildings. That's
the problem.
That's the problem. And that happened after Hurricane Iniki as well. Insurers figured they couldn't figure out how to make money because they were concerned that would Hurricane Iniki repeat itself the next year or the year after that. So we are in a very similar situation now, just involving condo buildings, where insurers have lost a lot of money, and now they're saying we just have to sort of thin our portfolio. I don't have a good answer for that. I'm sorry. I wish I did. But that's just what we're facing right now.
And I think that the issue to me is, and I think you may have touched on that, is that, we're talking about affordable housing being a big problem in Hawaii, right? You have rental housing, and you have these affordable sale projects, right? Well, this is going to slop over to them, that the cost is going to be so high because that building is still going to have insurance, that this is going to have an impact on a broader level, from my perspective, on affordable housing, because unless we solve this problem, it's going to affect the state's ability to provide affordable housing for sale, that is. So it's a big problem.
Do we not need to worry about earthquake insurance? Not discussed yet.
So earthquake insurance is not required for insurers to sell. Some insurers do actually sell earthquake coverage. I'm not sure, I don't believe loans require earthquake at this point in Hawaii. Is that true or false? Okay, so they confirmed that earthquake is not required. I'm in the insurance business, I worry about everything. So now, we are not California, we're not on the San Andreas Fault or the Northridge Fault or any of those things. We've had earthquake damage in Hawaii. I think the last time was 2006. The earthquake on the Big Island, several structures were damaged there. I'm not aware that any high-rise buildings had significant damage as a result of that event. But yeah, earthquake, you can find it. There are some specialty markets that will sell it, but it's up to your AOAO to make the decision if they want to purchase it or not.
So can insurance costs be added to the reserve?
That's a very good question. I actually don't know. I would have to defer that to the gentleman on the end of the table here.
What was the question? Insurance
Can you add insurance premiums to the cost of the reserves?
No, it's not a component with a useful life reserve. You can certainly put the deductibles in it because you're getting into these situations where you may have a $250,000 water damage deductible. You can certainly put that deductible in, or the hurricane deductible in your reserves. But every time you put something in reserves, it means reserve contributions go up. The earthquake insurance is interesting because I was involved in that, I think it was last legislative year, maybe the year before. Hawaii, just like flood zones, there's different flood zones, there's different earthquake zones. Other than the Big Island, we're in a very low risk earthquake zone here in Hawaii. Well, the average cost was estimated at $400 a unit if you force condos to buy earthquake insurance. It's a very expensive insurance, more expensive than flood insurance. Now, whether those numbers are right that were estimated, I don't know. we're trying to control costs and make it affordable for people. So we're going to have to balance some risk on the things we provide. The legislature can't say, I have to protect the consumer. You make so many legislative mandates, we can't afford it. So we've got to find ways to solve the problem with insurance. And we have to make some balancing on the risk we take. And, but the earthquake insurance thing is not a good idea to me. And at the same time, you can put the deductibles or a portion of the deductibles into your reserve study. It's not an official part of a component and useful life and all those things, but you can do it.
I'm reading something from my phone, and basically, once upon a time, this 50% fully funded reserve was a law. What happened to that? Because now, condominiums, they can do it, still be on a cash flow basis. And even Sue Savio said this in one of her presentations, that many states are mandating associations to have some sort of reserves. So I'm asking the legislature, why aren't they doing that to Hawaii, to Oahu? I guess the colony has.
Let me just explain this to you. When the original law was adopted, around 1995, it might have been 94, 93, mandating 50% funding by the year January 1, 2000. Percent funded is a methodology of funding reserves. There's two types of reserve studies, component method and pooling method. Under the component method, you measure the funding status as a percentage. Under the pooling method, you measure it as a cash flow, currently in Hawaii over 30 years. 99% of the United States of America uses the cash flow model for doing their reserves, because there's a lot of inconsistencies statistically with percent funded. However, the current law in Hawaii today is you have a choice. The board has to, it has to be in the budget, they have to disclose it, whether they're choosing the percent funded method of analysis or the cash flow method of analysis in doing their reserve study. But predominantly, the cash flow method is the most dominant method across the United States. And I would tell you this because I was the legislative liaison for the United States. Hawaii has some of the strictest reserve walls of any state. And so, yes, there could be improvements. Act 199 last year made a whole bunch of new disclosures, which would be helpful, but it's not perfect. But percent funded is just one methodology, cash flow is the other methodology. Both are provided for in the law. Cash flow is the dominant method, and you have to review the study and look at it and see what it says to make any determination how well off you are.
Why we don't streamline our property management companies. They make it so difficult to figure out what's going on. I don't understand why it's so expensive. We have why don't we post all of the condo docs and the information for the insurance and everything online instead of having to order it every single time? You get different answers. $355 I paid last week for a condo package. All of the answers were incorrect. It came piecemeal to me. They said it was leasehold, it was too simple, and then the new RR that's mandated, RR 105C, it was answered almost, the whole thing was answered not to my knowledge. And it's like all of the property management companies, Richard. I mean, it's all the realtors and the public. We can't go to the boards. That's crazy. You can't talk to your boards. The attorneys for the boards tell you they can't discuss your meetings. They can't record the meetings. If you can't be there and they've got it on Zoom, they're not going to record it. It's crazy. And we really need to streamline the systems. And I honestly think that you're part of the problem.
So let me answer that question, because I have to be very familiar with that question. First of all, document production. We all know we live in a society where you can scan them, change them, whatever it may be. The lenders and the demand a certified copy from the management company. That these are the true, including all the amendments to the declaration, the bylaws. So the lenders require that. And that's about $180 of what you just talked about. The other $180 is the Hawaii Association of Realtors Form RO105C, which is a 6-page legal form. It has to be issued within 10 days of the purchase, including the unit number. Right, so someone's got to fill it out, and there's a fee for it. So the average cost for what we call a condo disclosure package is $365. Now, if that association happens to be in a master association, and they happen to have a rec center association, it costs more. It's a cost of doing business. But going back to your fundamental question about boards and providing documents to owners, well, owners are entitled to go to the meetings by law. They're entitled to a whole list of documents for free by law. The problem is that the lender won't accept those documents from the owner. They have to get them from the management company. So it's an issue that needs to be addressed, but to say there's not a basis for why it's done the way it is today, there is.
Well, we need somebody to help us, because every single deal we have to supply condo docs. And the condo docs, you know, they come out willy-nilly, you pick a minutes, property, and you pay for it. It's crazy.
We're gonna move to another person because we're running out of time. So Albert, yeah, someone.
Hi, I'm Shannon Carroll. I have the privilege of being president of a 54-year-old fabulous condo, 284 units in Waikiki. But I'm 20 years older than my building. So it's a senior building and a super senior. That is voluntary. I volunteer to take the target right here in my chest from all the owners. And I'd like all of you to understand that revenue comes from one source, right? The revenue comes from maintenance fees. So when you talk about the association, you talk about the reserve fund, let the association pay for that, or get a special assessment, it's still coming from the owners. So when the legislature makes mandates, for example, which I support, a lot of them, but one of them is like sprinklers for a 60, 70, 80, 90-year-old building that was built to code back then. We were all built to code. Now you want us to retrofit the building and blanket and say, no funding for you, you figure it out out of your own pocket. So if there's anything that you could do to see, you know, there's got to be a way to do grants or whatever, fund it for the old buildings, for the senior buildings. That I know is the dreamland, but anyway. It would be wonderful if a board, we cannot hire people, we can't fire them, we can't regulate what their background is. We welcome them all. We have a 9-person board of Noblesville. But we all have one vote, a majority rules. But I thank you tonight for being here. But please consider, when you put out these mandates for us senior buildings, 60s, 70s, 80s, and 90s, that we also are seniors living in that building on fixed incomes.
Just to clarify, that was a mandate. So we are in the state, so we did not mandate that, but we certainly can look at your problems. But it is a city council. It was a city council ordinance. So again, it really requires all of you to testify when it comes before the body, like the city council. So I'm going to move on to one question, which is back to the insurance companies. Increase in condo insurance premiums. Will any of the insurance companies' premiums be used to repay the payouts on insurance claims made by residents and businesses devastated by Lahaina, Maui firestorm? And then added to that, what happened to decades of insurance payments collected by these companies that were not spent toward actual payouts? There should be a surplus of monies to cover current claims by the insured. So, can you
the first part of the question was Will premiums being collected now be used to pay Lahaina claims? The answer is no. That's not the way it works. The premiums that were paid by the policyholders who lost their properties on Lahaina, and all premiums collected up until that point were basically the basis for the insurers to make payments on those claims. Insurers are required to have a certain amount of something called policyholder surplus. And for Lahaina, a number of insurers had to dip into their surplus because the losses were so large. And that surplus is accumulated over years of whatever profits the insurer may make. There's also mandates for financial soundness that dictate how much surplus an insurer should have based on the risks that they have in their portfolio.
Just to add to that, should the monies from insureds be placed in a trust reserve fund to ensure that insurance companies do not use collected monies to invest in their own real estate or other investments, and or worst case scenario, taking unspent money, then discontinue their businesses in the state, leaving the insured holding an empty bag, which happened in Florida.
Rule number one in the insurance business is don't be Florida. There's really bad stuff that's been happening in Florida for a long time. Just read the first part of the question.
So basically it's saying, should there be a trust reserve fund to ensure that the money stays?
Right, so that's that surplus that each insurer accumulates over time. Another important thing is, I'm a property casualty insurer, so we insure buildings, we insure workers' compensation, we insure accidents, liability, car crashes, that sort of thing. The investments we make are highly regulated, and if you were to look at a typical property casualty's portfolio of investments, it's largely going to be things like municipal bonds, other types of bonds, a very small amount of equities, very, very little real estate. Life insurance companies tend to have a lot more real estate because they pay out, less often for better defined events like how long somebody is going to live. So the sort of escrow fund or reserve fund is really the surplus that each insurer maintains.
I wanted to thank the panel. This was a very informative discussion. My name is Michael. Quick questions, two-part questions, so different people may need to answer this. This is for the banking folks, I guess. My first question is, as I understand it, I understand the rules and there are no exceptions for hurricanes, but as I understand the Fannie and Freddie rules, there are exceptions for earthquakes to the extent you can prove the risk of loss is less than the total value. And is that correct? Is that your understanding too of the regulations? You don't know, okay. Let's assume that is true, because I've read them. And then I guess my second question is for the legislators on the panel. Why aren't we, or maybe you are, talking to our federal, Congress, members of Congress, our representatives and our senators to have a discussion with Fannie and Freddie, assuming there is an exception for earthquake, to deal with this issue hurricane? Because we've run the models. I can tell you that our risk of loss is probably 30 to 35% of the total value of our condominium association, and that sure would generate a lot of savings if someone decided to move in that direction.
Okay, regarding your first question on earthquake, can we get back to you? If you want to give us your name and contact, we can check it out for you. With respect to speaking to Fannie and Freddie, we have spoken to Fannie and Freddie, the lenders have. And unfortunately, they are not making any changes to the rules. In fact, on February 7th, they actually came out with a lender letter clarifying that 100% replacement is required.
I understand those are current rules, but I'm saying I believe there's an earthquake exception. I'm not sure why we couldn't lobby.
Yes, on the second question, I actually just had a conversation with Senator Schatz on Saturday, and I discussed this topic with him. So he and his office are aware of the situation. And basically what I told him was that, you know, if we are going to continue to pursue housing, especially affordable housing, using vertical buildings, then we need to address what is happening here with this insurance situation, and especially how Fannie is handling it. So they are well aware of what's happening.
I'll also add that at the Mortgage Bankers Association of Hawaii, we have our vice president who will be attending the national, what we call our national conference in DC, and she will be speaking to our senators and reps there as well.
I want to thank everyone. We have got to the village, you know, to close.
I have one quick question.
You have a quick question? Where is it?
Here. Over here. I just wanted to tell you some additional numbers that I find are astronomical. I live in a large condo complex in Hawaii County. Our insurance company was one of the main three that said that they wouldn't reinsure us within the last 3 months. The board has scrambled to try and come up with numbers. Our insurance for last year was $340,000. This year is going to be $3,500,000. It's unbelievable. I can't even fathom that kind of an increase. I have a one-bedroom unit that my increase alone, just the increase for insurance, is over $4,000. I heard you say that, you know, a small one-bedroom would be like a $1,000. I mean, I'm at a loss what we do at this point. They've said they've explored everybody. It's taken 20, because they've also contacted the other insurers. They said they're not going to take any additional condos. So they've had to put together a consortium of 20 insurance companies coming together, and that's where the charges are. So I guess I wanted to point out to the legislature that it's critical that something be done very quickly. You know, what's going to happen is there's going to be a sell-off on condos because people can't afford them, and everybody's going to lose a lot of value. So it has to be done quickly. I was also going to ask if the legislature's considered some kind of a joint project where maybe the catastrophic events covered by the state and all the minor insurance is covered by the regular insurance companies. Maybe that would get the insurance companies back in. I don't know if that's a consideration or if that even makes any sense, but somehow I think there's a lot larger problems out there than everybody realizes. Our board had added a 100% increase because they thought 100% increase over last year would cover it, and it's 1,000%. So I mean, it's not even close. So anyway, I also wanted to ask one last question. How quickly is the legislature going to take action? Is it going to be done prior to the May closing, do you think?
The session goes until May, so we are going through the process right now where all of these bills are being heard. We're having hearings, so the more that you testify about these kinds of problems, so that it becomes much more in the front of us to do something, and maybe some of these bills can be amended to include some of the kinds of issues that you're bringing up tonight. So I would really urge everyone to look at these bills. As Speaker Psyche said, it will be on getting information back to you as to when these hearings are, what those bills are. Read them carefully because they change along the way. And as you testify, some of the issues that you bring up and some of the possible solutions you bring up could be included and amended in the bill. So please read them carefully and do include some of the suggestions that you have, and that may be something that can be looked at by the committees that hear the bills. So with that, well, we will, okay. So Albert, do we still have a mic? One more, just one more.
Really directed to you four people up there. You know, we're very similar to Florida. Florida's surrounded by water on 3 sides. We're surrounded by water all over, and we're in danger of hurricanes. Have any of you or the legislatures been in contact with any of the legislatures in Florida to see how they're handling their situation? Because I know a lot of the insurance companies, they're bailed out of Florida, and Florida, the state, had to set up their own insurance. Do we have a plan in case these 3 insurance companies that we have represented in our buildings here bail on us? Do we have a plan B, what we are going to do? Because this is a big, big problem.
Well, that is the proposal that we're working on right now, which is to beef up the Hawaii Hurricane Relief Fund as well as the HPIA fund to provide gap coverage for the buildings that are underinsured. So that is exactly what we're working on.
And the thing is, have we talked to these people in Florida? Because why reinvent the wheel? They maybe have some ideas that we can use here.
Yeah, well, I haven't spoken with anyone from Florida or from these other states, but we can. And I think my understanding is that the insurance, the industries are very different, the way they're regulated in the different states. So I mean, there are going to be differences, but we can do that. That's a good suggestion.
So on behalf of Speaker Saiki and Representative Tam and Nishimoto, myself, and to thanking you all for joining us, Mike, Karen, Victor, and Richard, and all of you. I want to thank all of you. Good night.
Nice to meet you guys. Interesting.
Available, and we will then send it back to you.